going on with budget reconciliation in Congress.
All right, another one, a good theme to keep our eyes on. Thanks, guys. George Till, Scott Durfee, great way to close out the show. Trading 360 with Nicole Petalides is coming up next from New York. I'll see you this afternoon. Finish up the week, 2 p.m. Central Time. We'll see if we can hang on to this rally. Plenty of breathing room with the
Sorry, I don't know what's going on. I don't know why the stream died. Internet's fine, browser's fine. Burn you guts. I don't even know if you guys are back in here. It like automatically tries to reconnect, that's why like I'll start a stream and then it won't work and then I did get calls on one of these candles were red. Could just be the handle on this little inverse cup though. Not to be, we didn't quite hit the low. Pretty choppy this morning, really. You want to take profits wherever you can.
Documents. I mean, this story was just, I feel like this is definitely going to be a movie someday, frankly, because it is so wild to me. But we did hear that this jury has found him now guilty on all 7 criminal courts against him, as the FTX founder, does face a maximum sentence of 115 years in prison. So we do know that this was sort of the scheme that unraveled a lot of the trust in Bitcoin and overall the crypto space. So I do think that there was punishment to be had. This was a pretty major deal when we first got news of some of the ways that he had been deceitful, as well as overall FTX. But he pleaded not guilty to the charges, which were all tied to the collapse of late last year FTX and its sister hedge fund. We also did see that now the U.S. attorney for the Southern District of New York said that he perpetrated one of the biggest financial frauds in American history. While the cryptocurrency industry might be new, and with players like Sam Bankman-Fried might be new, this kind of corruption, he said, is as old as time. This case has always been about lying, cheating, stealing, and we have absolutely no patience for it. So pretty negative remarks, obviously, following the sentencing. Attorney General did say in a statement that he thought he was above the law. Today's verdict proves that he was wrong. So at least finally get some update regarding that. And I do think that it seems like the reaction to the sentencing was pretty positive, as there were, millions of dollars lost as a result of some of the schemes under FTX. So, well, I don't wish to be him today. I do think that at least we got some closure finally on this story.
Yeah, we certainly did. And I do look forward to that movie, because I'm sure it will be coming out. All right, let's talk about a big stock on the move. I was talking about all these green arrows we've been seeing, and really on the week, if you take a look, the Nasdaq's up 6%, the Russell's up 7%, the S&P is up almost 6%, the Dow up almost 5%, but there's one stock, Fortinet, that is a big loser on the day and on the week. Already off earlier lows, but still down about 16%.
Still saying the stream
right
is
now
not doing well,
earnings.
though.
Tell us what really disappointed investors about
What's
this one.
going on with that?
Yeah, and not really recovering at all on the session, which has been somewhat amazing to witness. I mean, it has held on to these losses, at least as of 11 a.m. Eastern time. But we did see this company plunging as a result of its third quarter results. They did say their 2024 outlook disappointed amid the growth in the market for
Closing
their
these
network
calls.
firewall applications. So
Yeah, not a good
what's
setup. I don't
interesting
like it.
about this space is that a lot of these various companies, like Palo Alto Networks, for example, has been crushing it. But Fortinet today, I think, completely shocking the market with its own set of guidance that was much different from some of these cybersecurity companies that we have heard from. We have seen that this company does have some pretty major exposure to the network firewall market. And as a result, it seems like some of these applications that typically do block unauthorized traffic and check web applications or malware were not necessarily working the way that they would have hoped. And they were very transparent about this in their most recent quarterly update. So the fact that you're basically admitting some fault is not exactly the sentiment you want on an earnings call. And we've said this, over and over in this earnings season, it feels like more and more the market is paying attention to these earnings calls. And if your sentiment isn't absolutely stellar, your stock just gets crushed. I feel like that's a lot what we're seeing today. So as a result, lots of analysts today lowering their price targets. Naturally, with a pretty sizable $9.5 move to the downside, pacing for its lowest close in over a year. Makes sense to see some updates here. Stifel downgrading shares, as well as Evercore, as well as JP Morgan. The list just goes on and on. Well, slashing their price targets pretty substantially to around $50 to $55 a share is where I'm seeing their updated price targets, which still does actually imply some upside from where we're currently trading at around $48.
Yeah, now the buy versus hold, not a single sell rating, but 20 buys and 20 sells, or I'm sorry, 20 holds. So very much split in terms of that neutral to bullish rating. But yeah, not a good day to be Fortinet or a Fortinet investor. All right, Jenny, we have to leave it there. Thanks so much.
Thanks, Caroline.
All right, let's get some insights on the news that's shaping the markets. And for that, we welcome in Joe Brusuelas, chief economist at RSM. He joins me here at the desk at the New York Stock Exchange. Joe, good to see you. Thanks for joining us.
Well, thanks for having me.
So we're going to pivot, and we were talking about
Oh,
earnings.
that was
Now we're gonna
my,
talk about the data. Of
that was
course,
my
the
internet.
jobs report, really the
Here's my
highlight
computer.
of the day and the week.
Weird.
Before we get into the implications for the Fed, just kind of want to break down this data first. What was the key takeaway? Market seems to like it.
Well, there's a good reason why, is because the labor market growth is cooling from the torrid pace we've observed over the past number of months, in addition to the idea that, hey, look, we got a very solid economy, robust gains in productivity. We added 150,000 jobs this month. That's twice the number that we need to stabilize employment. All while inflation's easing, and this is, I think, the big takeaway, wages are now rising above inflation. As we head into the traditional holiday spending season in the fourth quarter, consumers are well positioned to continue spending, albeit at a more modest pace. Moreover, we just had that Fortnite story. It looks to me like if you got productivity expanding at a rate it is, your earnings are going to be okay. This isn't the story that we had just a couple of months ago. Things are looking much better.
What about the 3.9% unemployment rate? Put that into perspective for us, because it's the highest we've seen in quite some time. Does it still imply a strong but obviously cooling economy, or how should we be looking at that?
So right now, at our estimate of full employment is 4%. So we're actually still a little above, probably where we need to be, but who's counting at that point? 3.94%. Look, demographics are going to ensure that we're going to have a low employment rate going forward for the foreseeable future. This is just not your father's labor market where we had excess supply. We're going to have insufficient labor supply for a long period of time, even with some gains in overall immigration, which I think is boosting both productivity and output. But for right now, I'll take that 3.9% unemployment rate. I'm just not worried about that.
And how much did the strikes that we've seen, whether
Sure.
it be UAW or healthcare or the entertainment strikes, how much did those play a part in these figures?
Great question. There were over 48,000 people on strike during the month of October. So if you're out on strike, you're not counted as employed, right? But there was an additional 33,000 people who were furloughed because of those strikes in the manufacturing sector alone. So actually, when we're looking at that 150, you're going to add those 33,000 workers
Back
back
him down
in.
a little bit.
So the top line actually undershoots probably where employment is.
See if we can
Over
retest
the
the
last
low
3
here.
months, we've added 204,000. That looks about right to me. That's a nice, modest run rate.
Okay, so the big question, of course, is what does this all mean for Jay Powell and company? How much heat does this take off of the Fed?
This is real easy. Fed's done.
Okay.
Yeah, they're going to be on extended pause. I think early next year they're going to begin to pivot to begin focusing on stabilizing long-term real yields. Now, even though the Fed's not hiking rates, real yields can still increase, right? And that's one of the risks around the outlook. They're going to want to bring that back. And then at one point, my guess is sometime in the second quarter, begin cutting rates. But that's a 2024 story right now.
Right, but cutting rates, why? Because
Okay.
is it because inflation is back at target, or is it because this cooling but still pretty resilient economy actually starts to get a bit weaker and the Fed needs to?
It doesn't have to do with the things firms are trading on. It has more to do with corporate earnings and where they're going, and that has to do with the cost of doing business. So if you're out there and you're a mid-sized firm, you got to pay a SOFR rate, which is about 5.2. And our survey data implies there's a risk premium of about 800 basis points on top of that. So if you need to go out and get a commercial industrial loan, you're going to be paying between 10 and 15% based on the quality of your balance sheet. So that needs to come back if we want the economic expansion to continue. That's why the Fed's going to focus on real yields. Now, here's what's interesting, Caroline. Real yields right now, if you use the 10-year Treasury inflation protected security as the benchmark, sitting around 2.5%. Over the last 10 years, that's averaged about 0.25% or 25 basis points. In order for us to continue expanding, we need to see real rates come back down, probably to 1 to 1.5%. We're already hearing that from some of the Fed presidents, and I think that once we are certain that, okay, by the end of next year, inflation is going to be in that 2.5% range, they can then begin thinking about easing what's very restrictive policy right now. And I think that's the key for next year.
But 2.5% is still above the Fed's target.
We're not going back to 2%.
So the Fed's target's just going to change, or they're just going to...
Well, over time. So what they'll do is in their next policy review, I think they'll change it, right? But if you look at inflation expectations, my preferred metrics, the 5-year forward, it floats around 2.5 to 3%. That's actually well anchored and fairly stable. You know, and the best of research implies that once inflation settles in somewhere between 3 and 4%, firms and households just get on with it. The Fed's going to get on with it too. And I think it's going to be one of the big narratives of next year.
Okay, I'm getting the wrap signal, so we have to make it quick. Are we avoiding the recession all out even next year?
We should quit talking about the false dichotomy of recession versus soft landing and just start talking about what's a very impressive business expansion.
All right, we'll leave it there. Joe, always a pleasure. Thanks so much. That was Jared Brusuelas of RSM. All right, plenty more to come on Trading 360. Next up, it's the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the technicals, and Mike Shore will take us through the trades for First Solar, Shopify, and Oracle.
I like Caroline.
That's next.
Doing its chop. I wait for a low day, maybe for calls, or wait for a handle to the upside. I mean, I might wait for that for calls. Your rally up, I don't know. See what happens at high day. 3 puts. For just a range trade. Market's giving us. Good morning again. Did we make everyone over? Do I want to get migrated? Is the stream even still going? One of those days Dink gets hit the light like more than once. It's a good thing.
Academy. Mike and Ben, so good to have you both here with us on on this Friday. Mike, let's start with you and your first trade, First Solar. It's a winner today, up about 2%, but year to date hasn't done all that well, basically flat on the year. Tell us why you're trading this one and what the trade is.
Yeah, these were high flyers that we saw before, and they just aren't. I mean, there's a lot of things inputting into that, but they just cannot, on earnings and on everything else, they just can't get going here. And until I'm proven wrong, I'm going to keep fading these up moves, and so I'm going to do that with First Solar with an iron condor.
You caught that one, Guts. That's awesome.
So can you take us through the actual trade?
Wait, 7 a.m. Oh, 7 a.m. your time.
Solar?
Yeah, so
Yeah, it's the first one that started. I had to reboot after that.
We weren't up 2%, so I was actually looking at a little bit lower, but we can just roll our strikes up. So either we can do
no problem.
This would be the 30, 35, 150, 155. We should be able to do that for about $2.50. So if we do that, then that's
I'm bearish on First Solar also.
Or we can move our strikes up $2 a piece. So we can do like the 132 half, 137 half, 152 half, 157 half, and that should be trading somewhere in the neighborhood of about $2. So either one of those, basically, not necessarily that we're going to crater from here, but that I'm just not a believer of the upside. We can't hold that 20-day moving average. Actually, today we're a little bit above it right now, but with every excuse in the world that it has to go up, it's still not going up, and so I'm going to fade those until I'm wrong.
All right, so Ben, Mike's not a believer in First Solar.
I'm
kind of easy to see why when you look at the performance year to date. But take us through the chart. Anything that maybe doesn't look quite as bearish to you?
No, Caroline, it's been tough to find a bright spot in shares of FSLR, that's for sure. Mostly range bound as of recent, but definitely in a well-defined trend environment to the downside. Let's dive into, first and foremost, a 4-hour candle chart. I avoided the more intraday time frame on this one because it's very limited in terms of real conviction. I mentioned a very much chop type trade, and you can see that in terms of some of the price activity you've seen this fall. But I wanted to begin with the move we saw throughout June, July, into August, and the beginning of September, where we traded around this $200 level. So you can see not a lot of conviction, and then you see the sideways breakdown. So the move into the beginning of October, where we started to go a little bit more sideways again around the 145 level. So from what I'm seeing here, you've kind of got this upper extreme around 160 where we've run into some resistance. You've got a very well-defined low around 132, but the first line in the sand for the bears in terms of some of the weakness would be, again, that 160 level, but everything below 200 right now is still in a trend environment to the downside. Let's take a step back from this 4-hour candle chart here, and although we've got a fair amount of time on this chart, again, going back to, we're talking this summer, I wanted to show you what's going on because FSLR actually was in a bit of an uptrend, and that's why we look for these areas of value, because while we were trending higher, value's forming at higher and higher levels. So those that are looking to participate with the trend are going to be favoring long positions. Again, as we're forming this area of balance around 93, we're talking about into the basically throughout most of the year of 2022 into the fall of last year, and then we break out, and you can see these areas of consolidation that continue to form at higher and higher levels, and as each one forms, you're constantly referencing the prior. So while we were bouncing around 200 into this summer prior to the breakdown that we just looked at, again, some of that weakness, you can see that 157 was the key level. So taking out 157, definitely washing out or invalidating that working assumption here that value is moving at higher and higher levels, the market was trending higher. So this one's been in a bit of bearish pattern for a while. Again, in a bit of a range, but definitely not necessarily anything to get the bulls excited about at this point.
All right, so it sounds like we have some agreement. Mike, let's talk about your next trade, Shopify. It's off about 0.4% despite beating on both the top and bottom line yesterday. Tell us why you're trading this one.
So a continuation from yesterday's earnings report. We're seeing strong consumer spending. We're seeing expanded growth across the board, basically, from that we talked about in your last segment. And Shopify's at a great spot for that. So I was looking, actually, it did trigger. I'm looking at it along above 60.15. It actually spiked up about this morning, came back a little bit, so we can get that maybe for a little bit cheaper, I'm just going to go with a straight vertical spread. I'm going to go with the 62.65 call spread, and that should be trading, I would imagine, somewhere around 65, 70 cents. I haven't updated since we've got on here.
Okay. Ben, Shopify currently trading at $59.50 right now. What do you see in the chart for Shopify? Because this is a much different story than we saw for First Solar. This is a stock that's up 71% so far this year. I say so far this year. I guess we're closing in on the end of the year, but in 2023.
Yeah, similar in that we're in a bit of a trend environment to the downside on the longer term, but different in terms of what we've been seeing on the more intermediate and more recently, definitely on the short term, a spike up to say the least. And Shopify, a bit of a mess though. I'll show you why when I get down to these different time frames that I'm focused on. But let's begin first and foremost with this chart. We've got an hourly candle chart here. You can see the move lower that we saw over the last few weeks into the lows just last week, and that was 45. We spiked up, currently holding around the $60
10 minutes to
level
you close
here.
already. Wow.
A minute ago, we were just talking
SPY's
about
done nothing today.
Solar and how they validated
Just chopped.
that uptrend in the recent weakness that we had seen, that selling. Well, in this instance, kind of a mirror image. Shop invalidating a downtrend that we had been seeing with this most recent move up, because again, looking at these areas of consolidation, we were balancing around 53 into the lows. We formed a really well-defined area of consolidation around this 47 level, and then look what's happened with these earnings results. It's taken out key areas associated with areas that were established on the way down. So taking out 53 means that the working assumption that value's forming at lower and lower levels and is going to continue to do so is no longer a valid one, right? And you're kind of just guessing and hoping if you think the market's going to roll back over and get back down to that 47 level. Might it? Yes, but this is a good indication that significantly conditions have changed, to say the least. Let's take another step back here, because this is again a very, in many ways, the more granular time frame I want to look at here. I've got a 4-hour candle chart here. I said it was a bit of a mess. Not a lot of well-defined trend here, right? We had migration moving up into 71, and then we kind of broke down. But notice how we never really took out 48 with any real conviction here, right? And then we came back up. So, you know, this just doesn't provide much of a lean one way or the other. I always say, when in doubt, zoom out. And in this instance, you get a fair amount of clarity, right? We're talking about what I mentioned before in terms of much like First Solar. This longer-term trend to the downside, well-defined. Top left corner Caroline, bottom right. You can see most of this has just been kind of consolidation around this $50 level. But as long as we remain below 88, these most recent tops that we just came off of up around 80, they just look like additional sell opportunities similar to what we saw back in the beginning of 2022. So it's a well-defined range that we're established.
Got the flush, but it's probably low.
Upper and lower extreme,
These
kind
guys
of hanging out in
re-raised.
the middle thereof.
And they have a
Everything within
higher
this
flush.
right now is very random, but supportive of a downtrend here still.
Mm-hmm.
Yeah, when in doubt, zoom out. Certainly puts it
Queen.
into perspective
Sure
in
does.
terms of move. Impressive this year, but
Bad
not so
nothing.
much when you look at those old highs. All right, and finally, Mike, your last trade is for Oracle. It's up about 1% today, 1.2%, up about 7% this week. Tell us how you're trading this one.
Yeah, so, you know, I continue to like the enterprise and the cloud space in general. And the interesting thing is Oracle has earnings December 11th. Okay, so what I'm going to do here is it's a technical trade in that, you know, I'm long delta, so I'm bullish on the stock in a more grinding type of fashion. But almost more importantly, the way that I'm playing the options, I'm buying the 110 strike in December, which is after earnings, and then I'm going to sell the regular November 111 calls. So we do have we have $1 embedded in that call spread, and then we also have implied volatility after that we're buying, and so that's going to hold its value and probably will go up going into earnings. So that's going to help the long part of that, and then going out 2 weeks and just selling that basically to finance that long call. The decay of that, we're going to have a lot more in the front. So a grinding type of move up to its 50-day moving average, up at around a 111. That makes sense technically, and it's a great trade from the option side.
All right, Ben, December 11th, Oracle's earnings. I get to share my birthday with Oracle's earnings. I knew that date sounded familiar. All right, take us through the technicals. What stands out to you for Oracle, Ben?
Well, Caroline, I had a feeling that I'd be able to see a little bit more eye to eye and agree decidedly with Mike on this one, because all time frames across the board pointing in the same direction. Taking a look here at the more granulars we like to do, first and foremost, dive into the 5-minute chart with me and just look at the move we've seen off the lows from last week and the strong rally we saw up this week. We started out around that 100, 101 level, and then look at this big move up all the way up to 109, and you can see high conviction trade associated with the big move into the end of the week. No rejection of that. We're seeing us hold these upper levels here as of currently into the midday trade. And I just want to show you along the way up, the market establishes these areas of consolidation for us to keep an eye on and for us to reference. So again, if you're looking at where value is moving here, it's giving you a pretty good indication here that it's moving higher, right? So those that want to position with trend right now are favoring long positions and currently looking for opportunities to present themselves as we bounce around 108 and hold above 106. That's the area where you don't necessarily want to take out at this point, supportive of that working assumption that value continues to move higher and that continuation more likely than change, right? Well, that is the case, and it happens over time, and that's why this is a good working assumption to take on as a trader, right? It is, again, sometimes important to trade counter trend, but I personally like to position myself with this momentum to the upside. Now, in this instance, I want to paint two scenarios here because you can see a bullish pattern playing out, and then as we balance around 120, notice how this isn't necessarily what the bulls wanted to see, right? Lower lows, lower highs coming into play, but notice we're still holding above that key area 88. We always reference the prior area balance relative to the one that we're currently forming. Now, in this instance, I'm going to show you, giving the benefit of the doubt to the bulls, I kind of pulled out the fat crayon on this one and just sort of identified as this is one larger area balance. 88 still being significant, but again, not so much just this one area around 110. We sort of adapted this to just being this larger area here. Yeah, we're below the daily pivot at 112, but back above that opens up a door and retests this old high that we saw up around 127. Now, the reason I'm so willing to give the benefit of the doubt to the bulls here is not only because of the 5-minute time frame, and again, in this instance here, but I looked at the, well, take a look with me, the weekly time frame here, Caroline. This one spells it out. I mean, across the board, we're talking A to Z. This is a textbook example of what a trend environment looks like. And yeah, again, the recent weakness, not necessarily what the bulls wanted to see, but look where we are. We're kind of right back to one of those old highs. If we could find some support here, start to kind of balance in this range here right now, again, this would be just absolute trend to the upside. Technical analysis 101 playing out here. Gives us something to keep an eye on into the end of the year, that's for sure.
All right, all good points to make. Ben Lichtenstein, Mike Shore,
Lichtenstein.
thank you both so much for the technicals and the trades. Really appreciate it.
GME's come down a little
We're
bit.
going to spotlight big tech as
A
the
gap to
third
fill
quarter
down there.
earnings season begins to wind down. Our next guest is impressed by what Microsoft and Qualcomm are bringing to the table. Find out why when we come back.
Yeah, 2 pair. There, man. Pocket jacks. A pair of 6s? Pocket jacks isn't too bad of a call. Bit risky. But that's the advantage of that aggressive pre-flop. You already had skin in the game. Harder to fold once you've got chips out there like that. Straight, I don't want to be too aggressive. Now there's definitely a straight. Now there's definitely no straight. Dang. What do they need? Yeah, have fun. They just folded, they didn't even check. Alright, chopping around. Green candle now. Little volume coming in there. Oh, EU close. Interesting. Interesting. Yeah, that happened right at EU close. That red to green. 5. I don't like that at all. Dang it, dude. You weren't bluffing either. Or I guess you kind of were. Raise that heavy on the second 5 coming out. That sucked. That didn't have that 5. I had it in the bag, man. Had the kicker. 5, respecting the channel still. No hearts though. At least it's a rainbow. How'd you call that? Lots of different offsuits. About to get that great also. Great. Price he called.
Their expanded structure as well as looking at new markets to be able to expand. The implied move for this stock is sitting at around 6.6% to the upside and or downside. The total gross booking estimate is looking for a growth of 18.4% on a year-over-year basis. That's going to be the bread and butter of their business, but we're also going to be looking at mobility, and the estimate right now is to see 27% year-over-year growth. They have been able to once again manage their expenses as well as really focus on their efforts to expand their market share within this space, and that's been being reflected when you look at Lyft's and their earnings. They've seen the impact of the aggressive nature and competitiveness of this marketplace.
Yeah, someone's slow playing me.
Really
give me a chance to re-raise. I can fold.
Here. Let's see if the results are going to reconfirm that. That's going to be on Tuesday morning, by the way.
All right, yeah, much different story for Lyft. Although Lyft up 5% today and up about 12%
Everything's
this week,
up 5%.
Overall, much different year for Lyft. Kevin Green, Senior Markets Correspondent, thanks so much. All right, it's time to spotlight big tech and what we've learned from third quarter earnings season so far. For that, we welcome in Daniel Newman, CEO of the Futurum Group. He joins me here at the desk. Daniel, so good to see you. Thanks so much for joining us.
Thanks for having me.
All right, so of course, when it comes to big tech, there's a few key names that have really dominated.
I checked all the way to a full house.
Being one of them this week, but you have a list of quiet tech earnings winners that you brought with you. Tell us who came out on top there.
Yeah, you hit it with Apple, and Microsoft was the big winner this quarter. I just want to say that up front. But I'll spotlight 3. So the first one was Qualcomm. Qualcomm, a company that's largely known for handset, mobile device manufacturing, been a really tough year for handsets, for PCs. The company beat, it raised, and it was finally able to talk about China in a way that was positive for the business. We've seen so much conflict with China, chip companies, and Qualcomm's dependence on that market. They saw for the first time mid-double-digit growth in activity in silicon for the chipsets for their handsets. That was really important for the company, enabling them to beat. But they also saw some really strong numbers in automotive and had a big announcement around a future PC, ARM-based PC, that they're going to enter into the market, making them a competitor, and the specs show it has a real shot of competing in that tough to enter space. The next one is going to be ServiceNow. Had the chance to speak to CEO Bill McDermott. He obviously feels very good, but this is one of these where the AI hype meets AI reality. Bill McDermott has been long talking about this kind of cycle towards automation, productivity, and efficiency, but that company, against all the backdrops of pressures, of cost cuttings, has solutions, services, and products in its portfolio that basically enable companies to get more efficient, more productive, and invest in generative AI capabilities. And then the third one, and this was a toss-up. I was deciding between Intel and AMD, but AMD kind of always gets a little more tailwind. Intel. So sat down with Pat Gelsinger after earnings, and they, the bar has been lowered, but they're stepping over it, and they're stepping over it more consistently. They made a commitment to getting 5 processes out in 4 years. That means their next chip, getting it out in 4 years. They're meeting their timelines, Caroline. And not only that, but they're actually beating on profits, revenues, and showing some meaningful growth in their foundry business. And as the U.S. is trying to fight this battle to be able to produce more of our own leading edge chips, what other company are we going to turn to? Intel is the only one, so we want to see a strong Intel, despite how the market sometimes likes to be a little tougher on them than other silicon names.
All right, so those are the quiet tech winners. All 3 big winners this week, although Qualcomm really has had the least impressive performance in 2023 from a stock perspective. So I guess at what point does it catch up to the stock price?
Well, the company is in that kind of handset devices category along with PC makers. It doesn't get the same multiple as, say, the NVIDIAs or the AMDs. And I think that really is largely because of the China dependence. I think people are concerned about the China dependence. And if you get lumped into that category of devices, it tends to be very negative on that PE ratio going forward. I think the company's diversification, it's got a $30 billion automotive pipeline. And we all know how many chips are going to go into the smart cars of the future, Caroline. And as that ends up becoming reality, it's only just starting to turn to revenue. So I look at trends like that as the key trends for people to say, okay, we see a stronger, more valuable future earnings, and we can put that value behind the company and behind the investment. So it's going to take a little while, but they're doing a lot of the right things in AI and in their device portfolio.
And you mentioned that Microsoft was the big earnings winner in your mind. Will Microsoft continue to be the winner as you look ahead, especially as it competes against quite a few companies now in the AI race?
Yeah, so our internal intelligence that we track shows big investments being vendor expansion and AI investment by enterprises. Microsoft is so embedded inside of every organization that they're naturally in the conversation of every company's generative and AI strategy. Now, I think it's going to be fierce competition at the cloud level. AWS is the biggest, Microsoft has the most diverse portfolio, and Google is well known for its AI innovation. Having said that, they're all going to end up inside of every enterprise. So what it's going to be is it's not fighting as a winner takes all. It's going to be fighting for the most innovative products, the most diversified portfolio, and then being able to get the largest share of wallet across the enterprise. But Microsoft it nailed its monetization story, Caroline. It nailed the 3% of our Azure revenue was driven by our AI innovation. And of course, $30 a head for Copilot. Most companies are struggling to give a clear metric. They won because they gave a clear metric.
Another name in the AI space that has had the opposite of stock performance as Microsoft has really been IBM. They have Watson X. It's an AI play, yet it's only up 5% year to date. Why do you think that one's out of favor? Are they just not up to snuff in terms of their technology?
Yeah, I'm glad you asked about them because I actually put them in that quiet winner category. I've spoken to both Arvind Krishna and Jim Kavanaugh in the past week. Operationally, the company's nailing it. They've done a very good job with Watson X, focused on enterprise. So the valuation is very enterprise-centric. The company doesn't always pop up in some of those more high hyper-growth names. They're talking mid-single digit. But when it comes to execution of its hybrid cloud AI strategy, delivering to customers, I believe they announced a multi-$100 million Watson X business impact, but across a multi-billion-dollar business, people want to see that number grow faster. I like what they're doing. And by the way, Caroline, they're offering an indemnification to enterprise customers that are going to use their Watson X generative technology, which others are doing. But I think it's really important because if companies are going to bet, invest, and try to move forward with generative AI, they need to know that some of that risk of what could go wrong in the code and the outputs that are created, that they're not alone. That if it creates something that's copyright violation, if they get code that's not there somehow, and I think IBM's stepping up there. But look, they were sturdier during the downturn of 21, 22. They actually saw some of the best performance. But now that you're seeing that more exuberance towards growth, IBM's always going to be more about stability, more about the dividend, and more about long-term shareholder value.
All right, we have to wrap, but I do
call.
want to ask you, because I know you've been
Hopefully more
meeting with so
aggressive.
many of these tech executives
More
one-on-one.
fold.
What's the biggest hurdle or the biggest challenge that they're most concerned about looking ahead?
Yeah, I think they're trying to find a way to tell an AI story and meet the market where it wants to hear about how that turns to dollars. I mean, we all know we can be more productive, we can get more efficiency, ChatGPT can write a blog for us, but the street wants to know, is a company going to incrementally pay? Is this protection? Are you just using AI to keep a customer? They want to bet. The investors that we're seeing, they want to bet on companies that clearly tell an AI story that says we're going to grow revenue, we're going to grow margin, and we're going to be stickier with our customers.
All right, we have to leave it there. Daniel, always a pleasure. Thanks so much for breaking all of that down for us. Really appreciate it. All right, coming up next, it's time for the disruptor. Skyworks just got downgraded after earnings. George Sillis is here to break down the stock and make an example trade. As we head to break, let's take a look at some of today's winners and losers in the S&P 500.
Yep, there's your SoFi. Channel being respected still. Whoever's asked about SoFi the other day. Even on another bullish day like today, it's not even up. It was, but wick down below it. Right, a king, an ace, a jack. Not a 9. This dude's totally bluffing. Oh, no way. No way. Oh, he's scared I had the straight. High, reaching for a new high there. Getting time for some boots. Boots. Oh, he hit it straight. Jeez, I didn't even notice. I got lucky with that full house. Oh, you hear that? Holy smokes. Phew. Does he roll reverse split? Let's see, can I land it? No. Maybe could have bluffed him off, I don't know.
Rating on the stock, but they did conservatively reduce their target to 120 from 130. And I think if you look at Skyworks, one of the things that you have to keep in mind is it doesn't necessarily have a lot of the industrial or automotive exposure as a percent of revenues like some of the other majors that I talked about, like On Semiconductor, because that stock has been really bad in terms of performance, especially in the last few weeks after they reported earnings. And lastly, I'll say this. If you look at Skyworks, they do have quite a bit of exposure to Apple in terms of their handsets, but they also have a broadening out exposure and revenue base with Android smartphones, including, of course, Android's or Google's Pixel phone and Motorola, which again uses Skyworks technologies implemented in their handsets.
Okay, so all of that considered, you mentioned a few of the more positive analyst ratings.
Yeah.
I was just doing the math on my trusty iPhone calculator. 54% of analysts at this point are in the hold camp. So what's your example trade for a company like Skyworks that hasn't, taken part in this year's rally at all? It's still down almost 1% year to date. How would you trade this one?
5.
Yeah, so I mean, you bring up a good point.
Lucky he was
if you just
favored.
look at the chart, you have to go back to last December, or late last December, where we actually hit a support area of $85. And in fact, we hit that again today as the stock opened up. So we're going to use that as an area of support. And considering the guidance downgrade that the company provided, some of the analysts are reducing their targets, but we're basically trading post earnings. So there's a little bit more visibility and stability in the price. So with that said, we could actually look at that $85 level and sell some cash secured puts at that level. Going out to December, you could actually sell the 85s for about $2 a share or $200 a contract. So effectively, we're giving us, if you place this trade, or a trader could see about a $7 decline between here and, of course, the current price before you're at risk of the break even, which is $83. So that $2 of premium is about a 2.8% yield to strike price between now and expiration of 42 days. But you do have flexibility, because between the current price and the break-even price of $83, you have basically about a 9% give back of a potential, just in case it does pull back in the coming weeks.
All right. Thanks so much for that trade.
Okay,
and
it's
the
5
breakdown
again.
of Skyworks. Stuart Phillips, have a
Yeah,
great
sure, I'll give it
weekend.
back to him. His favorite, that King Ace.
Coming up
No,
next,
he
it's
might not
time
have
for our
anything.
360
Or his
round. Our
all
panel
ends.
is taking a closer look at Apple earnings. What's next for the tech giant headed into the holiday season? That and more after this quick break.
Dang. Got this straight. Alright. Spy hitting that resistance here. Breaking out of this channel. This was the only really setup, and I didn't like that one. And this one, but that would have stopped me out. Well, really this one right here. They can take it to that resistance today. 438, 437.5 area. They could. Breaking out a little bit. Oh, I had the right idea when I got calls, but definitely didn't want to hold them through all this chop. The idea was that we didn't complete the inverse cup. Broke that channel I did have here. So, on a bullish continuation. Oh shoot, I folded. However, this still was bad. Liquidity chop. Wreck, yeah. So, I missed. So-called missed the trade. This.
The next wave of AI generation apps look like, increasing value there. And so I know the story with Apple's usually about the iPhone adoption, sales, and all that kind of stuff, but there's really more of a broadening in terms of where they're sourcing revenues and where that looks like it's going to come from in the future. So with stronger margins, they also have $162 billion sitting in cash. That's roughly the same market cap as Nike and the whole company. So if they do need to make a change in this higher interest rate environment, Apple can finance a lot of that by themselves. That just, again, makes that gross margin picture that much stronger for the company. And we see better growth past the next probably 2 to 3 quarters than what the market is likely looking at right now.
Okay, Brian Colello, services certainly the highlight, but I want to talk about devices. This, of course, includes at least the initial rollout of the new iPhone 15. What can we glean about the strength or maybe not of that phone, especially as we head into the key holiday shopping season?
I'd lose money on that transaction somehow.
And we always tell investors that this is peak Apple season, that this is the time to pay attention to this quarter.
Shouldn't have re-raised. Maybe this guy would have come along.
For the holiday season. Again, guiding to sort of flattish revenue on the iPhone side with some puts and takes, whether you're talking about commodities or a 14-week versus a 13-week quarter, or the timing or anything.
Come back into the channel,
I think
probably
it's
get some
in
puts.
line pretty much with what the market was relatively expecting. Again, a little light on revenue in total, but nothing crazy. I don't think anybody was expecting a super cycle year out of the iPhone 15 series, but in light of higher interest rates and everything else, we're glad to see that it wasn't a devastating cycle or a sharp downturn either. I mean, the Android space has been pretty horrific over the past 12 to 18 months. We're not seeing any sort of downturn to that degree.
Brian Mulberry, and it seems like China wasn't as bad as many were expecting, especially with some of the issues there, but also the rise in popularity of Huawei as well. How big of a headwind is China for Apple at this point?
I think it presents some significant challenges, but we probably see Apple, as they have been able to do over the last year, probably manage through about flat to the same 3% growth that you saw in iPhone sales total. So there's no question it's a very competitive marketplace. Huawei is definitely wanting to make inroads on that adoption rate for
green candle
the
here.
Chinese population. But we think that Apple has always been really good at positioning themselves just in terms of an ease of use on their particular hardware devices. They've always been good at interacting with consumers. It's one of the reasons their reputation is so strong in this particular space, and even in China, that we think that will probably carry through. It doesn't mean super strong beats or really high expectations. It just means that they're able to maintain their competitive edge even in the face of strong competition from Huawei.
All right, Brian Colello, just as we wrap things up, we only have a minute left. I was taking a look. Your fair value estimate for Apple is 150. Apple's currently trading at 175, so not a buyer at these levels. What would you prefer to buy instead?
I heard the prior guest on talking about Skyworks, and I'm probably in that camp of having that one as a buy. I have a 133 fair value there, particularly relative to the iPhone. We don't think Skyworks is getting cut out of the iPhone anytime soon. We don't think the iPhone is going away. It's not a fast grower, but certainly if you want to play Apple, I mean, if you think the iPhone is going to be flat, and if you think Skyworks content in there will be flat for years, and we think that it will, the stock is really cheap right now. We think that Skyworks as a company will earn, let's say $10 of adjusted EPS and free cash flow per share when times get better. So you're buying a company at 90 right now. We think there's upside for long-term investors willing to ride it out. The other place I would go are automotive semiconductor makers. They've been hammered a bit, and auto doesn't seem to be rolling over that bad, and we like the secular trend of more chips per car, and that's still going to keep growing. There's probably an inventory correction on the way, but longer term, we think there's great growth there. So we'd be looking at names like ST Micro, NXP, Infineon.
All right, we have to leave it there. Brian
Look at this
Colello,
cup.
Morningstar, appreciate those picks and insights. And Brian
Either a
Mulberry,
double top we get up here, or
Management, appreciate your
cup
insights
and
as
handle
well.
potentially.
That's going to do it for Trading
Or bounce
360.
off
I'm
the
Caroline Woods. I'll be back
bottom of this
here
channel.
at 2 p.m. Eastern, but stay tuned because Fast Market is next.
Schwab Bank Investor Checking, the checking account
Wing.
built.
Water tastes good today. It's nice when water tastes good. The pear I folded. A reversal candle there. Reversal candle. SPY going again up 1%. See if it wants to retest up there. Suppose this was a good long there. I don't know. I don't like the choppiness today. Browser's so slow. What is happening? My computer again? My internet? There you go. Yeah, I did just grab those puts. A little sketchy, but what's nice is I'm close to a stop. I think I'll stop if we break that. I like that it's back in the channel. I like that it's at a high. And today seems kind of range bound. At the very least, it's a cup that's built here, so we should maybe see a little handle. We'll pull back for a handle. This isn't a double top.
Of its overall revenue, but it is one of the faster growing segments of its business. It did beat the estimates by about 4%, and it is growing at 16% on a year-over-year basis. The last time we saw that type of growth rate for services was back in December of 2021. Mac sales continue to disappoint the street's expectations. They were actually down 34% on a year-over-year basis. The street was looking at it being down around 25%. And when you're hearing some of the commentary on the call, one of the cautious things that I heard yesterday yesterday is the fact that they continue to put their estimates or their guidance moving forward, especially for the next quarter, is really showing flat, if not even slightly declining growth on a year-over-year basis. Now, the market's continuing to bid up this stock, even if we are seeing those revenue declines. I believe this was the third or fourth quarter that they've had revenue decline on a year-over-year basis, but the market continues to bid it up. So you are right. I think that the broader market is really lifting up Apple at this point. Let's see if it's going to be able to remain that well throughout the rest of this session, at least.
Kev, there's a little detail on the fourth quarter sales. I noticed, as you did, that they're projecting fourth quarter sales flat. And that surprised me going into a holiday season. But Kev, last year, 14 weeks in the fourth quarter. This year, 13 weeks in the third quarter, in the fourth quarter. If you add that on, they said that's as much as 7%. So is that flat reading for fourth quarter revenue a misread based on one less week? And the other thing, with all the weakness we're talking about, this stock is up 34% this year. So still pretty solid free cash flow, chugging along here on the numbers. But boy, this is still a company up 34% with some weakness in some of its numbers, Kev.
Yeah, I would think the CFO would obviously acknowledge the fact that you have these differences when it comes to weeks, and this is not uncommon. This does happen with companies all the time. So I would say that they, from the estimates or from the commentary that I heard, they were looking at comps being flat, and I would take that as being comparable to 13, 14. So I would say overall, I think the marketplace in itself, it is still continuing to provide a premium for Apple. I'm a little bit more cautious on this name. I don't believe that the China sales were just the impact of just consumer weakness within China. I think there's something brewing there because of this soft China ban. That's just my own judgment based on what we've seen not only from Apple, but from some of these other players, these international players out there. So I think that's going to be the biggest area of concern. And they're going to have to bring out a product that's going to be, that shocks the market, that provides growth. Right now, iPhones just aren't doing it. And the fact that they have this backlog for the 15 Pro and 15 Pro Max, they really didn't explain the reason why they had this supply issue that was going on. They didn't really call out that it was manufacturing issues or if it was demand issues in China. And I think that's an area of concern that probably would have brought the stock down a little bit more if we did not have this rally in the broader market.
You know what? I look at it this way. Apple's lucky that it's Apple at this point because any other company out there with this type of valuation, getting 4 straight quarters of declining revenues, I don't think the market would be too friendly to the rest of them. But it's Apple, as we all know. All right, thanks to Kevin Green, senior markets correspondent here on the network, breaking down the Apple earnings. But now let's bring in Joe Mazzola, director of trader education at Charles Schwab. Joe, I kind of wanted to get your take here. Kevin kind of went over the data points as far as the weak jobs number, which is supportive for equities. But this rally that we've seen so far this week is pretty spectacular. Biggest rally that we've seen in 2023 for equities.
Yeah, 5% on the week. And if you look at the sectors that are doing the best, it's really the cyclical sectors this week. Real estate up 9%, discretionary 7%, industrial 6%, and financial 6%. So big moves in some of the underperformers. And it really is an interest rate story, guys. I mean, that's what it comes down to. You get a pullback in the 10-year from 4.9 down to 4.5 and change, and that gives a little bit of that, keg in the powder. Or powder in the keg, I guess, excuse me, to the markets lifting off a bit. It'll be interesting to see if it's sustainable. It's a nice rally now, but I think that we need to see a little bit more of some breadth, and we're starting to get it. We're starting to get a little bit of that breadth from the 50 and the 200-day moving average in terms of stocks above those. In the S&P, we're close to around 50% of the stocks above their 50-day moving average. But, we want to see that follow through continue. I think one thing that's been constructive this week is you've seen it outside of the Magnificent Seven. You've gotten some of that momentum from some of the stocks outside of what's been a narrow leadership for most of the year.
Yeah, some of those beaten up names. We're going to talk about a couple of them, Home Depot and Lowe's, that are up 6-7% so far this week. So we've seen that rebound. Starbucks
There's a
after
new
their
high on
earnings
the spot. It's not
exploding to
high
the
today, but
upside, 2 or
I have
3
that little
standard
range.
deviation move. So we have seen some of the beaten down stocks kind of take that leadership role. But Kevin, as Joe mentioned, the 10-year yield down 30 basis points this week. Sorry, that's typically maybe a yearly kind of move, but 30 basis point fall in yields. That dollar getting creamed over the last few sessions. Also, I mean, this is a risk on